In this in-depth analysis of the private equity industry for Q3 2025, we break down the key trends shaping the industry and what that means for MBA and Master applicants, job seekers, and private equity professionals. So the first trend that we observed was the record deal value and decline in deal volume. Q3 2025 marked an all-time quarterly high for private equity deal value, with total global private equity investments surging to approximately $537 billion, of which the US accounted for over $300 billion. This massive deployment was enabled by a strategic pivot toward fewer, larger, and more transformational transactions. The volume of deals declined year over year, yet values soared, a dichotomy that underscores the market's current fixation on scale. The successful close of the reported $55 billion leveraged buyout of Electronic Arts, along with a total of 6 deals exceeding $10 billion in the quarter, which is matching the total for the entire first half of 2025, validated renewed sponsor confidence and the robust capacity of the private credit market to structure these mega buyouts. This go big or go home strategy is a direct consequence of immense aging dry powder rather than engaging in fragmented complex middle market deals. GPs are consolidating capital into few high conviction take private opportunities, forcing portfolio repositioning at an accelerated pace. The second trend that we noticed was the investors' prioritization of DPI. The most crucial pressure point in the private equity ecosystem is the lack of distribution. This trend has finally reversed. Global private equity exit value accelerated significantly, with year-to-date realization totaling approximately $470 billion, marking a 40% increase by value compared to the same period last year. This reacceleration was directly driven by mounting pressure from limited partners, many of whom rate DPI, or the distributions to paid-in capital, as the single most critical performance metric. DPI is an ROI metric that measures the capital return to investors compared to their initial investment. A DPI of 1 is a scenario where the investors receive the investment back. Anything larger than 1 is a profit. The public market provided a vital exit avenue, the reopening of the private equity-backed IPO market for high-quality assets, which collectively raised over $18 billion globally, allowed sponsors to monetize flagship investments. Prioritizing liquidity, even with partial profits, is now the preferred strategy over perpetual unrealized gains. The shift could be an early signal that investors have slowly lost confidence in the boom and bust cycle of markets and industries. The third trend that we observed was the essential services shift. Q3 capital deployment reflected a deliberate defensive sector rotation, moving capital away from high volatility, pure-play technology companies towards recession-resilient sectors. Allocation to healthcare and financial services globally more than doubled year over year as investors prioritize industries less susceptible to geopolitical risk and trade friction. However, the most striking quantitative move was into infrastructure assets, which saw investment reach approximately $126.3 billion through Q3, already at 3-year high. This massive infrastructure allocation spanning data centers, driven by the AI capex boom, utilities, and energy transition assets, signifying private equity's view of them as essential services, offering stable, long-duration cash flows and effective inflation hedges. This strategic shift underscores a core tenet of modern private equity. Value is now defined by structural resilience and the ability to generate predictable returns in a volatile macroeconomic environment. The fourth trend that we observed was the focus on operational value creation. In a high cost of capital environment, the primary driver of private equity returns have definitely shifted from multiple expansion, that is, buying low and selling high, to deep operational value creation. General partners are now rigorously emphasizing cost optimization, commercial excellence, and margin expansion post an acquisition. This focus has spurred a massive build-out of internal value creation teams within private equity firms, demanding specialized functional experts in digital, pricing, and supply chain management. Private equity is moving past exploration to implementation. Firms are using AI in due diligence to accelerate data processing by up to 70% and deploying it post an acquisition for high impact use cases like dynamic pricing optimization, supply chain efficiency, and customer retention analytics. This operational focus has created a competitive advantage for firms that have successfully embedded data scientists and AI experts within their deal and portfolio teams. For instance, over 40% of operating partners at surveyed firms now have a digital focus, underscoring that operational expertise now is synonymous with technological capability. The fifth trend that we observed was the narrowing of valuation gaps. The acceleration of deal flow in quarter three was structurally enabled by the narrowing of the long-standing valuation gap between buyers and sellers, resolving a major hurdle that had choked deal volume for over 2 years. According to GP sentiment, 2/3 of general partners reported that the gap had narrowed significantly, reflecting a market recalibration. This alignment was driven by two factors. Sellers, that is GPs facing DPI pressure, became more realistic in their ask, and buyers, that is GPs flush with dry powder, became more confident in future earnings visibility, particularly due to expectations of stabilizing interest rates. The renewed conviction allowed sponsors to employ more creative deal structures, including earnouts and contingent clauses, to bring the remaining price differences and maintain deal momentum. The sixth trend that we observed was the participation of high net worth individuals and retail capital in private equity. Despite global PE fundraising remaining subdued year to date, down roughly 25% from 2024, the industry has a clear long-term strategic focus that is tapping the vast pool of high net worth individuals and retail capital. The strategic search for alternative capital was amplified by regulatory changes in the US that potentially allow for the inclusion of alternative assets within defined contribution plans like 401ks. With an estimated $9 trillion held in these US defined contribution plans, even small allocations could generate $500 to $600 billion in new capital over time. This prospect has become a core strategic priority. Over 90% of GP surveyed are interested in or actively developing tokenized, semi-liquid, or open-ended structures to meet the unique liquidity and reporting needs of the wealth channel. The seventh trend that we observed was the private credit's continued dominance. Private credit has solidified its role as the dominant financing source for private equity, systematically displacing traditional bank debt in the leveraged buyout space. This segment saw continued growth in assets under management and has become the de facto lending option, particularly for mid-market and large complex buyouts. Private credit funds provided speed and certainty of execution that banks often cannot match under stricter capital requirements and regulations. The competition is intense, but the market stability is evidenced by the generally low leveraged loan default rates, which is around 1.2% as of early 2025. Sponsors continue to utilize flexible financing tools, including increased use of payment in kind or PIK toggles and amend and extend transactions to manage portfolio companies' liquidity. For in-depth industry trends, salary growth analysis of M7 and top 20 MBA, and curricular analysis of investment banking, private equity, consulting, and technology careers, subscribe to F1GMAT Premium at premium.f1gmat.com/subscribe.